America faces serious financial problems. Foreclosure rates have escalated. Financial markets are down. Banks are failing. And companies are going bankrupt. Homeowners need help saving their homes from foreclosure, and the financial markets need help avoiding the domino effect of widespread bankruptcies. Besides homeowners losing their home to foreclosure, financial markets are having problems because they cannot sell billions of dollars of mortgage-backed securities. A mortgage-backed security, which I explain in more detail later, is like a stock, but is based on home mortgages. We need a plan that will reduce the number of foreclosures and make it easier to sell mortgage-backed securities. Bad mortgages are causing the increase in foreclosures and the illiquid mortgage-backed securities market. But if Congress makes a new plan to turn bad mortgages into good mortgages, we can fix this crisis. Even before the current crisis, foreclosures were part of the mortgage process. The most common causes of foreclosure were divorce, job loss, major illness, death, or some other major change that affected the homeowner's finances. And these foreclosures, things outside the mortgage, led to the foreclosure. People with good mortgages do sometimes lose their homes. The increased rate of foreclosures, however, is mostly due to bad mortgages. A bad mortgage has a problem in the loan itself. It leads to foreclosure because that mortgage was a bad idea to begin with. Some people get mortgages that they cannot afford to pay. Every month it is harder and harder for them to pay all of their bills. Eventually, they fall behind in their mortgage payments and they lose their house. Because the monthly mortgage payment was more than they could afford, it was a bad mortgage. They should not have had the mortgage to begin with. How do people get into these bad mortgages if they cannot afford the monthly payments? Usually, potential homeowners are lying to themselves. They know that they cannot afford the monthly payment, but they convince themselves that they will make more money or control their spending. The mortgage bank is also lying to itself. The bank knows that homeowners should not spend more than 35% of their monthly income on their mortgage, but the bank loans the money anyway. And sometimes the lies are more sinister. The homeowner might lie about her income on the mortgage application, and the bank helps her lie by ignoring her paycheck stubs and bank statements that clearly show she is lying about her income. Sometimes, though, the homeowner doesn't lie. The loan officer modifies her application without telling her, so the bank will approve the loan and the officer will get a commission. In all of these situations, the homeowner cannot afford the monthly payments. Slowly, she falls behind until she loses her home. A lie, an easily detectable lie, created a bad mortgage that led to foreclosure. Some bad mortgages have affordable monthly payments, but with a large balloon payment at the end of the loan. Homeowners are able to pay the low monthly payments, but when it is time to make the balloon payment, some homeowners cannot afford to pay tens of thousands or hundreds of thousands of dollars all at one time, and they lose their homes. Other mortgages have adjustable interest rates. If the interest rate goes up, then the monthly payment also goes up. As payments rise, some homeowners cannot afford the mortgage and they lose their home. So some people have mortgages that they can afford to pay now, but they will not be able to pay in the future. Adjustable rate mortgages and balloon payments are ticking time bombs waiting to explode the homeowner's finances and take away their house. Why do people get mortgages with ticking time bombs included? One reason is that people expect to move before the bomb explodes. People tend to buy a new home every 3 to 7 years, and the homeowner expects she will move before the balloon payment or interest rate is a problem. She also assumes that she will be able to easily sell her house at a profit whenever she wants to move. But as people are discovering, the housing market is down and it is very difficult to sell right now. Or if she doesn't want to move, she assumes she will be able to easily refinance the mortgage. What she didn't realize is that credit has been too easy to get for a long time, and now loans and refinancing are difficult to find. When the ticking time bomb in the mortgage explodes, the homeowner cannot pay, she can't sell her house, and she cannot refinance, so she loses her house to foreclosure. Intertwined with good people making bad mortgages are predatory lenders. These lenders and mortgage brokers make money from high mortgage fees, and they don't care if the homeowner can actually pay the mortgage. Their goal is to write as many mortgages as possible and let someone else care about payments and foreclosures. Of course, many of these predatory loans are bad mortgages. Foreclosures have a wide-reaching effect. They are devastating for the homeowner and her family. Homeless, with ruined credit, it takes years to rebuild their financial security. The value of the foreclosed house is reduced, and neighbors also see their homes' values reduced. But the effects of bad mortgages are felt far beyond the neighborhoods. Investment banks bundle mortgages, both good and bad mortgages, together into mortgage-backed securities. A mortgage-backed security is like part ownership of the entire bundle of mortgages. Not individual mortgages in the bundle, but a portion of the entire bundle. After an investor buys the mortgage-backed security, the bank then sends a portion of the total monthly mortgage payments to the investor. The amount of money the investor receives each month depends on how many people paid their mortgages that month. Obviously, an investor is willing to pay more for a mortgage-backed security if she believes that more people will pay their mortgage on time. So good mortgages increase the value of a mortgage-backed security, and bad mortgages decrease the value. But no one knows how many bad mortgages there are. By the time the mortgages are put into the bundle, it is impossible to know if the mortgage contains lies, or if the homeowner is going to fall behind in their payments, or if the homeowner will be able to handle the time bomb. Right now, it's impossible to tell a good mortgage from a bad mortgage. Since no one knows which mortgages in the bundle are bad, no one knows the value of the entire bundle. Would you buy a car if you didn't know if the engine worked? No. And no one wants to buy mortgage-backed securities without knowing how much they are worth. So, bad mortgages lead to foreclosures. Bad mortgages and foreclosures make it impossible to know the value of mortgage-backed securities. No one knows the value of mortgage-backed securities, so no one can sell them. Banks need cash to pay their bills and to give money to customers for withdrawals. Some banks must sell mortgages and mortgage-backed securities to raise cash, but since no one will buy them, some banks are going bankrupt. Some people think that if too many banks go bankrupt, then it will cause a domino effect. Here's how it might happen. First, more banks go bankrupt because they cannot sell mortgage-backed securities.